In a world where appearances can be deceiving, there's a hidden threat silently eroding the very fabric of our economy, threatening to plunge us into the depths of financial chaos. Hyperinflation. It's not just a distant nightmare from history, it's a relentless force that lurks in the shadows, impacting the value of every dollar in your pocket. But here's the unsettling truth. Hyperinflation is already here, quietly gnawing away at your purchasing power, and you may not even realize it yet. In this eye-opening exposé, we'll delve into the grim realities of hyperinflation, unmasking its hidden implications, and exploring the ripple effects it has on everyday people like you and me. In 1922, post-war Germany faced challenges under the newly formed Weimar Republic. The nation struggled with demanding war reparations from the victors of World War I. To rebuild the country and counter reduced productivity, the government resorted to printing more money. This reckless printing, along with borrowing and decreased production, devalued the German mark to the point where banknotes were used as fuel. In 1945, Hungary suffered from the aftermath of World War II, with over half of its factories and businesses destroyed. The government had no choice but to provide loans through private banks to rebuild. However, reckless money creation and borrowing led to a significant devaluation of the Hungarian pengo, resulting in rapid price increases. In Yugoslavia, in 1992, the breakup of the Soviet Union and ongoing conflicts in Croatia and Bosnia caused a reduction in industrial capacity. A trade embargo worsened the situation, leading the government to increase money printing and borrowing. This eventually resulted in hyperinflation. Similarly, in Zimbabwe in 2007, poorly planned policies caused capital flight and a decline in the exchange rate. This made importing essential farming supplies expensive and crippled the nation's output. The government resorted to printing money, but it failed to solve the crisis. In 2009, North Korea faced reduced farming output due to sanctions and unfavorable weather conditions, resulting in hyperinflation caused by money printing. Since 2016, Venezuela has been dealing with political instability and international sanctions. To maintain living standards, the government resorted to printing money, which combined with decreased output led to hyperinflation. In recent history, we've seen these common trends in various countries facing destabilizing events, such as wars, natural disasters, or policy mistakes that lead to a decline in productivity. These situations are often addressed with stimulus measures funded by printing money. Unfortunately, most examples result in failed states. Economic downturns are expected, and while market crashes may affect investors and delay retirement, a diversified portfolio usually recovers. However, hyperinflation is different and rarely leads to recovery without significant regime changes or abandoning the national currency, both unappealing options. In the United States, the COVID-19 pandemic had a devastating impact on both human lives and the economy. Millions lost jobs, businesses closed permanently, and industries like tourism and retail suffered greatly. To counter the economic decline, the U.S. printed a substantial amount of money and saw increased private sector borrowing. This, combined with reduced productivity due to the pandemic, raises concerns about inflation. We need to consider when inflation becomes an unsolvable problem, why some believe the USA is exempt from such consequences, and how individuals can protect themselves in worst-case scenarios. Examining these details will help us understand the potential risks and ways to mitigate them. Inflation is a strange idea that can be difficult for people to understand. We usually determine the value of things based on the amount of money, like dollars, yen, or euros, that we're willing to exchange for them. For instance, a house might be worth $500,000, a new car could cost $30,000, and a plumber might charge $200 for fixing a sink. It's amazing that Bitcoin is consistently trading for over $50,000. When it comes to assessing the value of a currency itself, these things get a little weird. The true value of a currency can be thought of as its exchange rate compared to other valuable things. We do this all the time with different currencies. For example, one American dollar can buy 110 Japanese yen, 85 euro cents, or $1.31 of Australian dollars. This exchange rate concept can also apply to other assets. For context, $1 US can buy 0.03 ounces of silver, 10 kilograms of rice, or 160 thousandths of a Bitcoin. Normally, we express these exchange rates the other way around, but you can see that market value is usually expressed as a dollar-to-goods equation. Let's consider the relationship between the exchange rate of American dollars and Australian dollars. Currently, one American dollar is buying approximately 1.31 Australian dollars, which means the American dollar is slightly more valuable than the Australian dollar. There are several factors that could impact this relationship. Australian dollars or American dollars could become more or less valuable. However, even the idea of value can be confusing. We tend to think of value in terms of goodness. If America were to fall into chaos, the goodness of American dollars would decrease, and as a result, Australian dollars would become relatively more valuable. Now, let's move on to another example. Consider the relationship between the US dollar and the S&P 500 index, which consists of the 500 largest American companies. At the beginning of 2020, this index became less good due to various struggles faced by companies, such as supply chain disruptions and reduced travel and hospitality activities. Despite this, the index's value in dollars increased. Either this equation is illogical or the true value of dollars has decreased faster than the value of these companies. Normally, an appreciating stock market is seen as a positive thing, but this perception is based on measuring value in terms of dollars. If the stock market goes up, we usually think it's because the companies in that market are doing well for their investors. But we don't think it's because the value of our currency has decreased. Here's another way to think about it. If the stock market, housing prices, and wages all increased by 50% in a year, would we consider it a good thing? But if the cost of groceries became 50% more expensive in that same year, we would start to worry. Normally, inflation is measured using the Consumer Price Index, or CPI, which includes a range of goods and services that represent consumer spending habits in a country. Usually, the value of these items is closely related to other assets in the short to medium term. For example, if real estate becomes more expensive, rent will also increase, and businesses will have to charge more to stay competitive. These additional charges are reflected as increased prices in the Consumer Price Index. But here's the strange thing. Inflation has remained below 3% during this time of increased money supply. This becomes even more perplexing when you consider that the prices of iron ore, lumber, corn, and soybeans have significantly risen. However, the Consumer Price Index, which includes goods made from these materials, has hardly changed. So what's happening? Is there some creative or potentially fraudulent accounting going on, or is the US immune to inflation? So far, the two significant factors to consider are that the US has printed more money while not producing as many goods. This means there is more money bidding for fewer goods, leading to higher prices due to simple supply and demand. These price increases have primarily occurred in asset markets such as stocks, cryptocurrencies, real estate, and raw materials. Despite the direct relationship between these asset markets and consumer goods and services, the Consumer Price Index, which measures inflation, has remained low. The reason for this might be that people are still hesitant to spend too much money. The savings rate in the US is currently at its highest level in recent history, indicating a preference for investment assets over regular consumption. However, this situation won't last forever. Once people regain confidence and have the opportunity to spend, history suggests that they will quickly exhaust their savings. In many examples seen in the past, hyperinflation started a year or two after significant money printing began. The US's potential saving grace is its status as the world reserve currency. This means that the value of the US dollar depends not only on its domestic purchasing power, but also on its global purchasing power. Other countries hold trillions of US dollars in their reserves, making it a widely recognized and accepted currency for international transactions. However, the US dollar status as the world reserve currency does not provide unlimited protection against depreciation, especially in a situation where the global economy is severely impacted, such as a global pandemic. Given these circumstances, the question arises, how can one prepare for potential inflation? The traditional approach is to hold real assets like precious metals, productive real estate, or stocks in companies that are less affected by currency fluctuations. Newer options might include cryptocurrencies. Another direct solution is shorting currency. This means borrowing money, exchanging it for underlying assets, and hoping that the borrowed money becomes worth less in the future. In an environment where sophisticated investors anticipate inflation, they tend to take on more debt to invest, especially when interest rates are low. This increases demand and prices for investments while also injecting more cash into circulation, ultimately causing inflation. Wealthy individuals understand this and use debt to purchase stable assets as a hedge against inflation. It's important to note that this is an oversimplified explanation, and the effects of inflation can vary in different situations. However, understanding these concepts can help individuals make informed decisions regarding their financial preparations. What strategies do you think can shield us from the storm of hyperinflation? Is it the traditional path of tangible assets or the revolutionary realm of cryptocurrencies? Let's have your thoughts in the comment section below.